In the last video, we discussed that unless this time is different, the more you pay for gold or anything else, the lower your subsequent returns are going to be. Now in this video, we're going to talk about the arguments that gold bugs use to support the price of gold and believe that gold is going to be rising in the future. And the first argument that we're going to talk about is that gold is a great hedge against inflation. In other words, gold protects your purchasing power in periods of high inflation. Now it's a little bit strange to talk about gold because there's really not that much of a history for it, given that it was illegal to own gold personally between 1933 and 1975. So the only real data we've got is from 1975 to the present, which I think is a long enough time period, but some people may disagree. Either way, when we look at the relationship between gold and unexpected inflation between 1975 and now, what we see is no real relationship at all. Now when we look at this graph, most of the observations sort of cluster in a ball around the origin, and that means that there's no linear relationship here between the price of gold change and the rate of unexpected inflation. And what does that mean? Well, think of it like this. If there is a linear relationship between two things, like corporate earnings and stock market returns for the next year, for example, you'd expect to see a line. So when a thing along the horizontal axis moves up, or is positive, the thing that's tracked along the vertical axis would also rise, and if one fell, the other should fall, and so on. But what do we see here? We see that sometimes inflation rose by an unexpected amount, and sometimes gold rose in price. Sometimes it fell in price. Sometimes inflation was muted and gold rallied. Sometimes it didn't. Basically, this cluster around the origin suggests that there's a very weak relationship between gold and inflation historically. I haven't done this, but I suspect that if you ran inflation against a host of other variables, you'd get at least as strong or as weak a relationship. Gold and the number of Jack Russell Terriers born in that year, and so on. Now let's look at another graph that compares inflation and the spot price of gold. What this line is showing us is the ratio of the price of gold to the US CPI. It's averaged about 3.2 times, i.e. gold is on average 3.2 times more expensive than CPI since 1975. It's been quite volatile over the time horizon, and at the time this graph was done, the ratio was 7.3 times, which is higher than any time in history except for 1980. After gold hits a peak or a trough, it tends to mean revert to this 3.2 level or so over the subsequent decade. Now what leaps out at me here is the volatility of the stuff. It moves around in price much more rapidly and much more vigorously than inflation actually does. And if gold tracked inflation, it'd be far less choppy. Therefore, to my mind at least, the relationship between inflation and gold is a very, very weak relationship. So those people who suggest that gold is a great way to protect your purchasing power in periods of high inflation maybe aren't aware of the historical record of gold, or maybe somehow believe that inflation is going to take on a different character from 2014 onward. They haven't presented how inflation is going to be different in the coming decades, but if we look at history as any guide and the relationship between gold and inflation in the past, there is no relationship, and therefore gold as inflation hedge is a very, very weak argument.